Hi there, this is Homes and Loans with Angela and my co-worker over here, Colleen, the best mortgage broker in the area.
Hey, good afternoon. I'm Colleen Mitchell with CMG Home Loans.
So we are entering the new year. If this is your first time with
Yeah.
us, thank you so,
Happy New
so
Year.
much. Yes, Happy New Year. Thanks for joining us. Please like, follow, check us out on YouTube, on Spotify. We're here to help and answer any questions you might have. So we are in the first couple weeks of 2026.
Yeah.
A
New
lot
year.
going on. So we're
Yeah.
excited to jump into that and share what we have for you guys. So on the loan side, we're going to start with Colleen. And what is new this year in 2026 as far as loans?
So effective actually mid-November, Fannie Mae had actually removed their minimum credit score. So it used to be 620. So in order to get a conventional loan, you had to be at a minimum of 620. So even if you had a big, large down payment, it really didn't matter. You had to be at 620. So they've removed the minimum credit score.
Which I think that's huge because I think this probably goes with a lot of first-time home buyers as my guess. They're probably not as aware of how important their credit score is until they go to buy that first house and then they realize, wait, I'm at 600. And then they're, flustered trying to figure out how do I get it up to 650 or 680 because not even on the loan aspect of side of things, but the interest rate is going to be affected by that. So even if they have a 650 versus an 800, that's also going to affect their payment because of the whole aspect of the interest rate.
Correct. And when they were below a 620, our only alternative was FHA.
Yeah.
So if they weren't buying a primary residence, though, we really didn't have an outlet for, let's say, an investor if they were below that.
Yeah.
So I ran one recently, and the credit score was a 605, and they were putting 20% down, and I was able to get an approval. Before
amazing.
that change, that wouldn't have happened.
Yeah, so that was a conventional buyer?
That was a conventional buyer, and my alternative was to switch them to FHA, which means they would have had PMI, because it doesn't matter how much you put down with FHA. You still got to pay mortgage insurance, even though the rate's sometimes a little bit better. It's just when you weigh the mortgage insurance versus maybe taking a conventional loan with a little bit higher interest rate, it's definitely a win-win, and it's definitely going to increase the buyers for this year. Yeah. So that was definitely a great change.
That's a big one. I think that's a big one because I think a lot of people realize that they've had troubles in the past.
Right.
And, maybe they went through a divorce, any kind of big life change or lost a job for a little bit and then, got behind on their bills.
Correct.
And now you can give a letter of explanation. You can get gift funds to kind of get that down payment down.
Correct.
Other people help you. And even if you have that lower credit score, you still have the ability to still buy something where that was off the table previously. Yeah. So that's great news. And then, of course, we have to talk about interest rates because as just this week, they were the lowest they've been in 3 years. Now, I know that doesn't equate across the board, but I'll let you explain that.
Yeah, I mean, interest rates right now are in the high fives to mid sixes, depending on the program, depending on the credit score. So rates are definitely trending down. Our overall estimation for this year, this came from corporate, is that we feel like we're going to be in the low to mid fives.
Yeah, that's
sometime
amazing.
During 2026, fingers crossed. Well, because I feel like with rates coming down, it's going to open up the doors for a lot more buyers that in the past, due to the affordability, maybe they didn't qualify based on where rates are and home values and that kind of thing.
Well, I think that's huge because the reality is we have so many sellers that have been on the fence about selling their house because they didn't then want to go buy at a higher interest rate, right?
They don't want to get rid of their 3%.
Exactly. They didn't want to leave that 3.5% behind, which is totally understandable. But with that being said, if it gets down to, the low fives, or say you're doing a 15-year and you're getting really low or maybe even to the high fours, or you decide to buy down the interest rate and you can get it into the fours, I mean, then that's all back on the table. Now you've got sellers coming back to the table that are willing to take their equity and buy something else because their interest rate isn't that far off anymore.
Exactly.
So I think it's a big game changer this year. I think with rates trending downward, it's going to really be great. You know what I wanted to ask you? I saw something the other day about the government or the administration purchasing $200 billion in mortgage-backed securities. Can you explain that to people and how that affects the market, our interest rates, things like that?
Yeah. So what determines the interest rates is the mortgage-backed securities. So by purchasing those mortgage-backed securities, it will bring those interest rates down.
Okay.
So that's one of the determinations of where rates are is that
Okay.
the mortgage-backed securities. So by purchasing those, it frees up more money for others, and that will trend the interest rates down.
Okay, well, that
so
sounds
that was
positive.
that was a big announcement last week.
Yeah.
So we actually had, I think I mentioned to you, corporate thought, our rate estimation was, the 5.5 to 5.75, and then after Trump made that announcement, now it's going to be more in the low to mid fives. So
Yeah.
we're hoping that
that
those
all happens.
right, those estimations are correct, and that rates trend down, because it's definitely going to open a lot more doors for our home buyers.
Oh, 100%. Because I think back of how much that difference of being at a payment between 5% and 5.5% versus 6.5%, and the
Right.
difference it makes in your payment, and so it
Exactly.
was taking buying power away from so many people,
Right.
and prices were still high. You know what I mean? And so now homes are sitting a little bit longer on the market, and we're
Right.
more of a balanced market here, where they average they're sitting 35 to 65 days in most areas. So that's kind of the norm now. But buyers have more power now, and now if interest rates come down, they can get back into a price point that really fits their budget.
So what are you seeing with prices out there? Are you seeing values stay stable? Are you seeing them drop a little based on where the market is?
It's a little bit of both. I mean, there are always certain areas where home values just stay. I
Right.
was showing property this past weekend, and you're in Dr. Phillips, for example. It's a very popular area. People
Right.
love the location, the schools, everything that's around there. And I mean, these homes needed so much work, and it's like the top price point. And I'm like, there's no way I would pay $550 for this. You know what I mean? But
Right.
they're not moving. They had a line of people waiting to see this house. Like,
Yeah.
we were waiting our turn. You know what I mean? So they don't really have any incentive to lower the price because it's about location in that scenario, right?
Right.
And then you have other ones where, like, you might see a lot of a neighborhood where you've got a lot of the same home.
Right.
And so when your competition is the exact same home, it's harder to stand out. And so normally, unless it does stand out some way, you're going to usually have to lower the price to get, that attention
Right.
that you're
Exactly.
looking for. So it really depends. But in general, I think homes are kind of staying pretty steady. About 35% of homes do at least one price reduction within 60 days. So that's kind of the norm. If you
Okay.
haven't gotten an offer after 30 days, by 60 days, you've usually done at least one price reduction.
Yeah, I've had a few clients that came in low and
Yep.
ended up kind of getting a good deals. But like you said, I think it depends on the seller's motivation. Do they need to move? Are they just wanting to downsize or upsize? So I think everybody's situation is going to be different depending on how negotiable they're going to be on the price.
I think buyers in general, they're out there seeing properties, but they're definitely pickier, right? So I'll have a listing, and it will have several showings. Everyone will give positive feedback, but nobody's willing to make an offer.
Yep.
Right. So they want to make sure it's 100% right. And a lot of times that comes down to the price. And then it
Exactly.
just depends how willing your seller is. Normally, once it's been sitting, even if you come in low, they're willing to negotiate, because up until this point, they haven't gotten any offers.
Right.
So that's kind of why I said it's more of like a buyers have the advantage right now.
Right.
And currently we're seeing a lot of buyers request closing costs or concessions
Yeah.
because they can.
They can.
Now, once interest rates go down, and if they do go down like we're thinking they're going to,
Right.
and then you have more competition with the buyers, they might lose that advantage of getting
Exactly,
those
yeah.
concessions, because they're going to be competing with another offer.
Yeah.
Is how I see things going, which is normally what happens. So
Fingers crossed. I think it's going to be a good year.
I actually do think it's going to be a good year. I think people need to start paying attention, because it's been quiet for so long, and they're not realizing, oh wait, rates are trending, mortgage-backed securities, like all of the little
Right.
details. Sellers are more apt to pay your closing costs, all of these things. And
Right.
so they could miss the boat. And if you don't get in right, well, it's right, then you'll be back into a competition
100%.
situation, and we don't want that. So
Yep.
anyway, so good stuff.
Good
I'm excited
stuff.
for
Exciting
2026.
stuff.
Yeah, for sure.
Excellent flow so far.
Okay, so I
Really
was going to
good.
cut
Yeah.
that there.
Yeah,
Just give
yeah.
us a moment to breathe.
Absolutely. Yeah, you said.
And then what was I going to say next? Because I wanted to go into that, but I know we're trying to cut them into so many. How many minutes were we there?
So right now we were at 10 minutes, just over 10 minutes. So that's great. And,
I kind of like those.
2 or 3
Yeah.
more
For the
minutes.
podcast, 'cause
I think we'll lose people if we're too long.
Yeah.
Yeah.
So that's
good.
why I try and keep them at like 10. And then when you did a little short, like 30-second, 90-second intro, that's great because then we're just trying to lead them there. You know what I
Right.
mean?
Absolutely. Yeah, anywhere between that, anything actually under that 20-minute mark is perfect for a single episode.
Yeah.
So
Okay.
you're right there.
Perfect.
Okay.
Okay. So, do I have to do the intro each time, or can we just
I
go
can
into?
flip it.
Love you. Okay, great. Okay, so Colleen, my next question for you is: what are the 3 biggest mistakes that you see buyers making? Like they're under contract, and they don't realize, and they make these 3 mistakes.
Well, the one thing we don't like is for them to take an offer on a new job right when you're in the middle. And I've
Oh.
had this happen, unfortunately, a few
Switching
times where they
jobs.
switched jobs in
Yeah.
the middle and they said, well, I gave you my pay stubs. Well, the important thing to understand is that even though we have pay stubs, we have W-2s, we're still gonna verify their employment within 10 days of closing.
Yes.
So, and typically the processor's doing that, within a week of closing. And I have had a few cases where we've called and they no longer work there.
You know what's funny? And I don't, maybe this is just a habit now because it must have happened at one time over like the last 20 years, but I always tell my clients, listen, they are going to call your employer the day of closing.
Yeah.
They're going to confirm that you still work there. And like, I always feel the need to tell people that now. And they're like, oh, they do. I'm like, yes. So you need to still be working at that job. Someone has to vouch
Yep.
that you still work there. Like,
And they sign something at closing. that
yeah.
they
So
still-
I'm like,
yeah, nothing's
it's
changed.
too funny.
Yeah.
But yeah, no, they just think if the income is the same or that they're fine. But
Yeah, I mean, knock on wood, most of those cases where they've switched jobs, I was able to make work. But where it gets a little tricky is if somebody is hourly. So if you start a brand new job and you're hourly and your hours vary, we typically have to have 30 days of pay stub, so it could push your closing date.
push it
So
out.
don't quit your job. Don't take a new job. Wait till you close and then take care of that. But don't
Yeah.
do it while you're midstream, even if you're pre-approved. If you're pre-approved and you haven't gone under contract yet, at least let your lender know,
Yeah.
hey, I've got this opportunity.
to change
And
jobs.
then talk to your lender about it before you just go ahead and make that decision because you don't want to mess up your pre-approval.
Yeah, that's what I always tell them. I'm like, well, call Colleen and ask her because you might have to be there for 2 months or have at least 2 pay stubs or be there for
Exactly.
30 days, whatever the case may be. And I know you'll know the guidelines.
Yeah, if they're salaried, that's
Different.
easy. Yeah, it's completely easy. I would say number 2 would be taking out additional debt during the process. So we're qualifying you based on what your current debt is and your income. So if you go and buy a new car or co-sign for an apartment for your child, I've had that a few
Don't
times.
co-sign.
Because the inquiries are there and sometimes randomly the underwriter could do a soft credit pull either in the process or towards the end, and we don't want to have to scramble at the end to try and get you qualified if you have co-signed
Yeah.
for a lease. And unfortunately that's happened to me a couple times where they think it's nothing,
Yeah,
but don't change anything with your credit while you're in the process.
that makes sense.
So, yeah. And I would say the third thing we see a lot is transferring funds. Like you've given us your bank statements, we're verifying your assets for closing, and there's this large deposit.
That's something I tell people all the time. They're
yeah.
like, well, my mother, best friend, sister, brother, whatever, is going to, they just gave me like $10,000 and I'm going to use that. I'm like, no, don't take it. Don't do anything. They're going to have to source it. We need to have like a proof of what bank account it came from. Like I already know Colleen's going to ask you for these things.
Yep.
So you're just going to make a lot more problems for you if you do it without first running it by the lender. Because
Exactly. Don't transfer money. Don't deposit cash. If you're getting gift funds, that is way easier to transfer the gift funds directly to the title company at
Yes.
closing, because then we're not delving into your
bank
your
account, you're gonna ask for
family's
their
bank
statements.
account. So if you
Yes.
transfer it prior to, we're going to ask for their bank statement. If you wait till closing, all we get is a gift letter.
Because I remember a scenario, I think we had, it was years ago, and I was like, well, where did you get this $7,000 that you deposited? Oh, I sold a car and they paid me cash.
Yeah.
I'm like, oh, this is terrible.
And
I
it's
just know
it's
not gonna-
completely fine to
I
use a
know.
car, but
Yeah.
we have to get a copy of the title, we have to get a bill of sale, and we have to get a valuation. So if you just sell it to some
Random person
individual
on
person,
Facebook
not
Marketplace.
not like a CarMax or something like
Yes.
that, we have to have some kind of estimation of what you sold it for.
Yeah.
So there's a lot more paperwork. So just, talk to your lender before you start doing those type of things so that we can counsel you on how to do it correctly. exactly.
Yes, yes. I always, the couple things that I always notice with people, three mistakes that they make. One is they're calling me and they're saying, "Oh, I saw this house. I love it. This is the price point." And I'm like, "Okay, great. So you've spoken to a lender. You have your pre-qual." No. Well, then you don't know that that's your price point or even what the payment is or what that whole payment even encompasses.
Right.
If there's an HOA, utilities, whatever a CDD, whatever the case may be. So that's one thing. People looking before they're actually qualifying always kind of blows my mind. And I
Right.
get it. It's fun to look at homes. I love to look at homes, but
We all do,
you
yeah.
need to know what your actual payment is going to be when
you
you're
need to know your
buying a home.
numbers, yeah, because you could think I want 400, 450, but you need to know what that equates to in a monthly mortgage
The
and
funny
make sure
thing
you
is,
qualify for it.
even when they're looking at like the monthly mortgage part of it, they generally don't understand the full scope of what they need for a down payment.
Right.
Like that doesn't even come into their mind. Like they don't. A lot of buyers are like, "Oh, well, what is 3.5%?" Or they think it's just the 3.5%. They don't
not
take
the
into
closing
account the
costs.
closing costs. And so they're like, "Well, why is this so much more? I saved 3.5% or I saved 5%," not knowing that you're going to have these other things associated with closing for your, title insurance, recording fees, the
All
title
the-
office, tax prorations, everything like this, a million different
Well,
things.
and
that
the
go into it.
inspections,
The inspections, the things you're going to be out of pocket,
Right.
the appraisal, right?
The
survey.
appraisal. If you're on septic, you want to get a septic inspection, termite inspection. So yeah, there's a lot of additional costs that you need to understand what you're looking at.
Now,
out of
listen,
pocket.
people, listen closely. That's why you need a professional, okay? Because we're here to tell you you need to take the whole big picture. It encompasses a lot of things, and that's why we work so well together because she's going to tell you this is what you need to know, and I'm going to whisper in your ear, okay, but don't buy any new furniture. Do not buy furniture before we close on this house. So
yeah, and get your estimate. It's amazing to me if I speak to a prospective buyer and I said, well, what have you been pre-approved for? What program? How much was your payment? Do you know what you need cash to close? No, I didn't get an estimate. Well, if
Yeah.
your lender won't give you an estimate at time of pre-approval, I probably would not work with them. You need to know your numbers.
Yes.
That is like the first thing that we send, the pre-approval letter along with the estimate, so that you understand how much you're looking at in a mortgage payment when you factor in taxes, insurance, mortgage insurance, if that applies, HOA dues. So you need to know what all of those equate to in a monthly
that,
payment.
and like I said, what you need to bring to closing.
Exactly.
So, and that's a
Exactly.
big misconception people have with new construction as well, and we'll have to dive into that. Maybe we'll dive into that a little bit later. But yeah, so that I would say not being qualified, knowing what the payment or their down payment is going to be is one of the biggest mistakes I see from people, and then I obviously direct them to a wonderful lender immediately. And the other is when we are set to close and we're a couple weeks out, and I'm checking in on things, with my clients, and then they're telling me about their weekend, and they're out looking at furniture or a new car, and I almost have a heart attack every time. Like, do not. They don't understand that as a lender, you're going to do another like soft pull to make sure prior to closing.
Well, that's random. It's random, but
But
yeah,
it does
sometimes
happen.
it
You
does
want to make
happen.
sure they didn't take out any new loans, new credit cards, new cars, anything, because
Exactly.
that affects their debt ratio. And I think they don't remember that. Like they think it's at one time an
Right.
application, but you can't take out new debt.
Yep.
So
I always appreciate when a client will email me or call and say, "Hey, I was thinking of, leaving just the U-Haul and it's going to cost me this, or get new furniture." They reach out and ask that question. I'm like, until you're clear to close, you can't do anything.
Yeah, don't do it.
Don't change anything about your credit profile while you're in the process. Wait until you either are clear to close or you close.
That's so true. So yeah, that's one of the other ones. And then like you said, when they want to they're buying a house, but then they want to co-sign on their daughter's loan. Just it's things like that. That
Exactly. And
people,
if you recently, let's say you co-signed for an auto loan,
mm-hmm.
typically we can exclude the auto loan as long as you can provide 12 months of proof of payment for your daughter or whoever. But if you just recently took out that car loan, we have to include that entire expense.
You know what I think is an important thing to mention that a lot of people don't understand, because you helped me with this a long, long time ago. My brother needed a loan, and he had been renting an apartment. He wanted to buy a house, and we needed to get him qualified, but he didn't really have any credit. So that scenario, but he could show that he paid his phone bill, he paid his rent for the last year, 2 years, and so I guess people don't realize that some people out there don't really have much credit. They might have a good
Correct.
credit score, but they can still get qualified as long as they can show a great payment history.
So yeah, some of our clients have what we call that thin credit.
Yes.
You don't have a lot of credit. So if you have thin credit, then we can look at alternate credit like rent, utilities, car insurance, cell phone. Obviously, that's not going to change your scores, but you can also contact those companies and have them report on your credit, which will help then boost your scores up. I see utilities on credit reports all the time now. It's a
Really?
great way to build your scores up
Without taking out credit
without
cards.
taking out a credit card, because some people don't want to take out credit cards, but credit cards are the best way to boost your credit. So even if it's a secured credit card that you take out with your bank.
You know, it's funny, in the past when credit scores weren't, when we did have this, hard line of 620, for example, and I'd be dealing with a client and you'd tell me, they're at 10, and, for whatever reason. And then the general rule of thumb was always, okay, well, your husband's at an 800, for example. And so have him add you to a credit card. He never even has to give it to you, right?
Correct.
And then just by being added to his pristine account where he's made
That helps
every
as well.
payment will boost your credit.
Yeah.
So a lot of people don't realize that. And so I give that advice a lot. Like, they're co-signing for their daughter. And I'm like, add her to your best credit card. You know what I
Exactly.
mean? Because then that will boost her credit history. You don't even have to give her the card or access to it, but your good payment history. Again, that only works if you have a good payment history, and you're going to continue to, because you obviously wouldn't want to hurt their credit in any way in the future.
Right.
But yeah, that's an easy thing.
The other
to do.
thing we run into is if we need alternate credit because they don't have enough credit, and we go to them and they say, well, the electric's in my wife's name, the water's in my wife's name, and she's not on the loan.
Yeah.
So you can also call and have your name added to
Added.
the utilities so that we can then use that credit reference. Obviously, you're a combined household, so you're both making those payments, so you might as well be on there as well. So that is another option.
Yeah, I agree. All good stuff. So it's the little tricks and things
Little
you need to
tricks.
know, because we're
That's
here
why
to
you
help.
need to talk to your lender. We'll help
Yeah.
guide you in telling you exactly how to document things correctly.
Yeah, because a lot of times people don't even realize they might have an old outstanding medical bill or something that's affecting their credit that they aren't even aware
Right.
of until they go to get a loan, and then you're there to be like, okay, this is what we need to do. We can write a letter. You might want to tell them a little bit about doing a rescore.
Right.
Okay, so a rescore is another thing that I've learned over the years with Colleen that we've done to
We
help
do
clients.
a lot of those. Yeah. So if you don't quite meet the minimum credit score, let's just say we want to get you a better rate. So I can run everyone through our credit simulator, and when we run it through, it'll say, pay this credit card to this amount, try to get this medical collection deleted. So I've actually getting ready to close one next week where I had to do that so they could get the bond program, which is an assistance program. That's a whole nother episode. So we wanted to make sure he could get the assistance fund. So I was able to bump him up to a 660. So it's usually, if it's minor stuff like paying down a credit card or maybe getting a collection deleted, that stuff's easy to do. But I would say I probably order rescores maybe 3 or 4 a month.
Yeah.
Just to help my buyers get their scores up.
So rescores can be used in a couple different ways if I remember correctly. So like you said, you do the credit simulator and it will say, okay, their balance on this credit card is a little high, have them pay it down to this amount, and it
Exactly.
will bring their credit up to this, this new number. Another thing is if they are disputing something and then they show that it was paid or they settle it and then they send you proof, you can send that in, correct?
Correct.
And get that removed or whatever the case may be, and again, boost their credit that way.
Exactly.
Any other ways we should know about? Those are usually the top two that if I recall. But
Yeah, it's usually revolving credit or collections. There's sometimes the collection companies, if you call and say, hey, look, I'll make the payment, but I need you to delete it off my credit, which is the one I just did. And they were able to get it deleted.
Okay.
So you have to ask, though.
Yeah.
They're not going to just delete it without you asking for it to be deleted. So obviously they want that payment.
Yes.
So a lot of times they will be willing to delete it. With medical collections, it's usually a given. They're going to delete it, but
Yeah.
if it's like a utility or something else, you really got to kind of negotiate that when you're willing to, pay that off.
Yeah, that makes sense. And I feel like even though I've been in the business a long time, things have definitely changed over, 10 plus years.
Oh, yeah.
Because I feel like in the past, if you had a bankruptcy, if you had a divorce, if you had a foreclosure, those all had really extended time limits on how they affected your credit. And I just don't feel like that's the case anymore.
No, so bankruptcy is 2 years for government loans.
2 years, that's it. It used to be like 10 or 7, I remember.
Well, so
Or maybe it's-
conventional's 4 years.
Okay.
But foreclosures are 3 years for government loans, and then for conventional, it's kind of 7 years. Sometimes.
For conventional?
Mm-hmm.
But it's only 3 if you're going like FHA?
Yeah.
That's
Yeah.
that always like surprises me because it's usually the conventional buyer that's going to have a better credit score and put more down. So
Yeah.
you would think they are less of a risk than an FHA buyer, but the
No.
FHA is going to back the lender with the insurance, and that's why it's
Exactly.
safer for them.
Exactly.
Yeah, I get it.
So, yeah,
So-
that's kind of the rule of thumb with
That private mortgage
bankruptcy
insurance
and-
protects them.
Exactly.
Yeah.
Exactly. So,
Too funny. Well, I know we threw a lot at you guys at that in that little episode. So we went over all kinds of things regarding credit and top mistakes that we see buyers
Yeah.
make, things like that. So on the next one, we will talk about, I guess, sellers.
sellers. There
we'll
we go.
go from there. Okay.
Sounds good.
We'll talk to you guys soon.
Bye.